It's Tuesday, December 17th. Welcome to MarketFoolery. I'm Chris Hill. Joining me in studio today from $1 Million Portfolio, Mike Olsen, and from Fool.com, Matt Koppenheffer. Happy Tuesday, gents.
Howdy. Hello, Chris.
We're going to do something we haven't done in a while, which is a little undervalued, overvalued. And for new listeners, I'll explain what that is in just a moment. But first, a couple of comments about the recent parties here at the Fool, because, Matt, you were out of town, but last Friday
sadly.
we had the annual Motley Fool holiday office party. Were you there, Mike?
Yeah, I was there.
It was a good time.
Oh, it was a good time.
It was a very good time, and got messages from listeners on Twitter. One of our listeners, Chris Hennessy, tweeted out a photo and said, "I volunteer to make bacon teenies at the Motley Fool Christmas party." And he tweeted a photo of some alcoholic beverage that involves, and I'm not making up this name, Mama Walker's maple bacon liqueur.
See, I just don't know. I don't know that works.
I'm not turning down this offer. I responded to him.
You know, but those beers that basically taste like a cured meat, see, it's just too much. I mean, I can have like one sip of it, and I think this is interesting and this is fun. Then I have 4, 5, and I'm over it. I'm already thirsty again.
I'm just saying, we get Chris Hennessy to the 2014 holiday party. We give the guy a shot.
It beats the Cirque du Soleil entertainment.
We had some odd entertainment. We had a couple of people who were doing sort of Cirque du Soleil style stuff. We had a random dude in a snowman outfit.
I liked him.
Cutting up the dance floor.
You know, his nose was removable.
I did not know that.
I removed his nose.
Like an
carrot.
Like an actual snowman.
Mm-hmm.
And last night, Monday night, we had, for the first time ever, we had a holiday party for our members, and had a bunch of people come out from the greater D.C. area. But we also streamed it live for any of our members. The video was up on the different service websites. And I want to thank one in particular, Don Sampson, one of our longtime listeners, also a member of our stock advisor service and $1 Million Portfolio.
Lovely gentleman.
I was a wonderful guy, and I was tasked with doing essentially 30 minutes of live interviews on this video stream. And as I think I didn't say this to you, I said this to David Hansen, who sits right next to you, Matt. I said to David, never again will I watch television coverage of New Year's Eve, Times Square, and never again will I make fun of the people who are filling the time on live TV.
It's stressful.
That is not an easy task.
You didn't even have floats that you could describe.
I didn't have floats. I did not have a lot of drunk people behind me. But Don Sampson was kind enough to give a few minutes of his time so I could talk with him on camera. So thank you to Don. Undervalued, overvalued. This is something we haven't done in a while. This is where we step back from the news of the day and we just look at the universe of stocks, and the guys come to the table with two stocks that they think are absolutely undervalued and absolutely overvalued. Let's start with the overvalued stocks. Matt Koppenheffer, what do you got out there?
Overvalued. I'm actually going with a banking pair today, and my overvalued stock is Bank of Internet. The ticker symbol is BOFI. Now, I got to be careful now about talking about overvalued, because I just recently did an interview with David Gardner. And one of the things that David Gardner loves in terms of stocks that he picks out is he likes to hear when people call them overvalued, because oftentimes these are fast-growing companies that are growing so fast and have so much opportunity that they look overvalued, but they end up delivering great returns. Bank of Internet certainly has been growing very fast, but at 4 times tangible book value now, almost 4 times tangible book value.
That's a lot of value creation.
That almost 4 times?
Almost 4 times.
But they don't have a
value.
branch infrastructure. It's fine.
Right. So it's not just about that multiple, although that sets up a giant hurdle for future returns. The other part of it is that the deposit, the mix of the deposits at Bank of Internet are very much skewed towards the fact that they pay more than anybody else does for deposits, which is great. But the problem with that is that when we start to get to an interest rate environment that's not at dead zero for everybody, I think that differentiation between what they're paying and what everybody else is paying starts to moderate a little bit. And I'll be curious to see how much deposits they're able to get to stick around.
This is a stock that has doubled in 2013.
It's been a good 2013. And I will point out that at the beginning of 2013, I had also said that Bank of Internet was overvalued.
So take it with a grain of salt.
Well, I mean, it was 2 times tangible book then.
Right.
I mean, so now the hurdle's higher. I mean, just saying.
Do you, when you think about this stock being overvalued, do you also have a scenario in mind where it drops suddenly? Is this a stock that you think, because we don't often see with banking stocks, and I get that this is not a big Wall Street bank. This isn't Wells Fargo we're talking about. But do you foresee a scenario where this stock drops 20% in a single day? And if so, what is that scenario? And I say 20%, but pick your number. Is there a scenario? Is it a bad earnings report?
Well, I think the two things that I'd point out that concern me about it. So the one that I said, the deposits. The other is that loans have grown so incredibly quickly, and this is a risk management business. Banking is a risk management business. So when you see loans grow that quickly, they've quadrupled, almost quadrupled, or more than quadrupled over the past 5 years. A good comp to that, Bank of the Ozarks, which has been a tremendous bank, little small nobody bank, but done so well over a very long period of time. Between 2002 and 2012, so a 10-year period, it took them to quadruple loans, and they've grown quite quickly. So the loans growing quickly, question marks about the deposits. If either of those comes home to roost and causes a drop in the stock, that's concerning to me enough that now the stock is dropping, and I'm not sure that that it's attractive to me. However, what would be attractive in terms of the price falling is if people just start to say, or investors start to say, well, 4 times tangible book value, that's too expensive. We're just randomly concerned about it, and so we're going to sell it off, which happens on the market.
And I think you bring up 2 really good points here, which is the first is that, and this is something we encounter in a very acute way when we try and hire people at the Fool, which is that banking is a people business, and you really have to hire the right people if you are going to price the risk effectively. And, scaling up quickly like that is an extraordinarily difficult thing. We've encountered that here when we try and hire people. And the second thing is that, you start to ask yourself, why is this service or what they do uniquely differentiated? I mean, this is a bank that exists on the internet. I hate to bust anyone's bubble here, but I don't know that that's unique in its own way.
I will say this in all seriousness. Great name. In terms of banks on the internet, I'm not saying they have a huge moat or anything like that, but they've got a great name.
My wife was a customer of NetBank, one of the original internet banks. Do either of you guys use NetBank today?
Never heard of it.
No.
It's because it went under.
Oh.
All right, Mike Olsen.
Fancy that.
What do you got in the overvalued universe?
All right, overvalued universe. This is something that's near and dear to my heart because I'm going to be heading home to my folks in New Jersey for the holidays, Michael Kors. And if you don't know, that's pretty popular there. And, when you look at fashion companies that have successfully exploited their premium position, they've sort of gradually and methodically expanded their presence from the high end to other offerings along this fashion spectrum. So, a company that starts in accessories will sort of gradually and slowly but surely push out. Kors has done this to a degree, but, recently they've really exploded in terms of their growth. And I worry that they put themselves in sort of a Bermuda Triangle as it relates to high fashion. Right now, they're trying to cater to a mass market in their Michael Kors brand. That's not me misspeaking, but it's Michael Kors. And the high end, by moving from a strictly luxe purveyor to one that also merchandises at Macy's, and they have a very large number of freestanding and wholesale stores. And so there's kind of there's a very intuitive logical tension here where, you ask yourself, can you maintain that high-end premium price point while catering to a mass market and not end up in a race to the bottom?
Isn't that the challenge that Coach has been facing over the last couple of years?
That's exactly what I was saying. And I'll cut to the sort of what was going to be the coup de grace, which is that, ironically, Michael Kors has about half the sales and profits of Coach, but it sports a higher market valuation than Coach.
How is that mathematically? How does that make any sense whatsoever?
You ask me. It's trading at 33 times earnings. And, notwithstanding, and this gets to the whole bit we were talking about with execution difficulties before, they've been expanding their retail outlets at a breakneck pace, and that introduces the potential for a relatively or a not insubstantial execution misstep. When you're trading at 33 times earnings, that's something you want to be wary of. Oh, and wait, there's more. So you know how everybody loves to talk about luxury goods purveyors and the China story and everything else?
Boy, if I had a nickel for every time I was at a party and someone wanted to talk to me about the China story as it relates to luxury goods.
Yeah, I mean, you are cool. You go to good parties. That didn't come up at the full holiday party, if you were wondering.
Not even once.
It could have,
Not even
but it
from
did
the
not.
snowman.
Not even from the snowman.
No, the snowman was not dressed in luxury goods. He had a scarf on. Sparse. But interestingly, when Coors went public, they kept their China operations as a separately traded entity. And so shareholders of Michael Kors do not participate in that upside from China. So, you know, a very, very large, you know, when people talk about Coach and everything else, Tiffany's, all of these luxury goods providers, they say China. Coors, not getting it.
No dice,
No.
as they would say in New Jersey.
No dice.
Before we move on to the undervalued stocks, I want to thank one of our listeners, Lisa Stephanie in Pennsylvania, who pointed out on Twitter that the second annual Stitcher Awards are going on for anyone who uses the Stitcher audio platform to listen to MarketFoolery or Motley Fool Money or Where the Money Is. And she very nicely nominated us. So, hey, if you're on Stitcher, throw a little love our way with the podcast nominations, particularly for our newest podcast, Where the Money Is, which you can catch every day. Matt Koppenheffer and David Hansen geeking out on the financial services sector.
Yeah, we get geeky. It's ugly.
All right, we've done the overvalued. Let's talk undervalued. And it's almost hard to believe that given the run the market has had in 2013, that there are undervalued stocks out there, and yet they do exist. What do you got, Matt?
Like I said, I'm going with a banking pair here, and David and I on Where the Money Is. We're talking about this the other day. We were reviewing an article that was that was arguing that Bank of America should trade below book value. It is currently trading below book value, and this article was arguing that it should continue to trade below book value, pointing to its current returns. It's got a very below average return on assets, which is no bueno. But essentially, when I look at the difference between Bank of Internet, Bank of America, Bank of Internet growing very fast, a lot of optimism around the company, around what it's doing. Good reason for that. It's been growing very quickly. Bank of America, on the other hand, there is no optimism. Optimism does not exist. And I think that there is this perception, this is what we were talking about with that article, that what we are seeing right now in terms of the returns from Bank of America will persist on into the foreseeable future. The problem with that is that the economy is continuing to turn. The interest rate environment at some point will turn. Both of those are basically free earnings bumps for a bank like Bank of America. In addition, it continues to clean up its balance sheet in terms of the number of bad loans that it has on its balance sheet. They had to hire a ton of people to deal with those bad loans, to deal with foreclosures. They will continue to let those people go. That takes costs out of the system. And in addition, although the lawsuits and the settlements are probably not over yet, those are going to continue to dwindle as well, and that's been a big drag on earnings as well. So I think people will be surprised 3 years down the road how much Bank of America is earning. This
is a stock that has had a pretty good 2013, though. This has been a market beater this year. You're saying it just hasn't beaten it enough.
Well, we were talking about Bank of Internet trading at 4 times tangible book value. Bank of America is just a scotch over tangible book value.
All right.
So even after all of that, it got knocked down so far during the financial crisis that even after a huge run, it's still trading at a very low multiple.
Is 2014 the year that the countrywide mess is finally behind them, or is that still 2-3 years away?
2-3 years away, at least.
Okay. Mike Olsen, what do you got?
I have a company called Boardwalk Pipeline Partners. That's pretty boring. And
you know what, though?
And I just ran out of coffee.
when you're looking for undervalued stocks, boring is probably one of the first places you want to look.
Yeah, so this company, what they do is they're an operator of natural gas pipelines. That is, they transport natural gas from one point to another, and storage facilities. And this is really sort of the energy equivalent of a toll booth. there are huge barriers to entry in this business. The cost to replicate a pipeline is absolutely prohibitive. And moreover, government regulations actually prohibit the construction of competing pipelines unless an economic need can be demonstrated. In the case of storage, there is an inherent constraint on capacity just because natural gas is stored in salt caverns, spent aquifers, and old wells, which obviously we aren't creating at a breakneck pace. Boardwalk is unique in that they basically have sort of an annuity-esque cash flow stream. They earn about 80% of their revenue via fixed contract or fixed fee, what they call them are reservation fees. And so effectively speaking, a company says, I want to have X amount of your pipeline or storage space. And in exchange for that, they pay them a fee, regardless of whether or not they use it. So more recently, the shares have come under pressure for two reasons. The first is this is a big dividend-paying stock. They're what's called the Master Limited Partnership. And just about anything dividend-related gets absolutely hammered whenever there's talk of Fed tapering. The other thing is that as natural gas prices have declined, and there's been some decline in geographic pricing for the regions within which Boardwalk operates, they have had a little bit of trouble increasing prices, and in fact, pricing has come under pressure as they have renewed these contracts. I think you have to take kind of a long-term view here, which is that if you look at a company like this and you look at natural gas prices, right now, on the demand side, there's some very favorable dynamics afoot for natural gas. You're going to see higher consumption from power generation, exports, and industrial use. And then on the supply side, natural gas drilling can't really compete with oil at today's price thresholds. And so in order to incentivize new drilling, you're going to have to see higher natural gas prices. That bodes favorably for Boardwalk's position. Right now, you get paid what appears to be a sustainable 8% yield. And at the helm, you have a proven capital allocator in the Lowe's family.
When you look at this stock in 2013, it was doing pretty well up until about late October. And since late October, it's fallen 25, 30%, something in that order. Right. Is that due to more than just the reasons you gave, the talk of tapering from the QE program? I think it's a mix of that and the operational. As I was saying, what appears to be a sustainable 8% yield, they're operating right on the razor's edge with respect to that yield. The distribution is covered, but it's tight. And then, there are ongoing concerns surrounding the state of negotiations on their new contracts. As I said, I don't really care so much if the dividend gets cut. I'm sure the market's going to go ahead and freak out here. But I think, you're going to get a 7.5% yield if you don't get an 8% yield. Does that really scare me? But moreover, the shares are going to get absolutely scalped if that does happen. And so then you might be getting an 8% yield anyway. I think the fundamental attractiveness of this business remains intact. The Fed tapering stuff, to me, that's really all just noise in the context of a business like this. Their contracts, I think that, you are going to see some pressure for the near term. Long term, though, this is a very attractive business for the reasons I said. And the ticker?
BWP.
We'll wrap up there. Mike Olsen, Matt Koppenheffer. Guys, thanks for being here.
Thanks, Chris.
Cheers.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's it for this edition of Market Foolery. The show is mixed by Ann Henry. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.